Let's talk about something that's totally transformed our financial markets, an invisible force moving faster than you can blink. Is it the key to a hyper-efficient future, or is it just mayhem waiting to happen?
Yeah, that quote really hits the nail on the head, doesn't it? 1 second you're on solid ground, and the next, bam, the floor just disappears. And the prime suspect in this vanishing act? It's a technology that operates at the very edge of what's physically possible. All right, so here's how we're going to break this all down. First, we're going to look at the moment that trapdoor actually opened. Then, we'll dive into the light-speed tech that makes it all happen. We'll explore its two kind of conflicting personalities, see how its actions can spread through the market like a virus, and finally, we'll ask the big question, what does this all mean for the stability of our markets?
To really get what's at stake here, we have to rewind. We're going back to one single, absolutely chaotic afternoon in May of 2010 that sent shivers down the spine of the entire financial world.
I want you to just picture this. In the time it takes to grab a cup of coffee, almost $1 trillion in value just vanished, gone. You had huge household name companies trading for pennies. And then, just as fast as it happened, everything snapped back. And this wasn't because of some big news story. Nope. This was the machines glitching out.
And that wild event gave us a name for this whole phenomenon, the flash crash. It also gave us the two key ingredients we need to unpack. Number one, automated trading systems. And number two, something called thin market liquidity, which, sounds super technical, but it's really just a fancy way of saying that when everyone tried to sell at once, poof, there was nobody left to buy.
So what is this automated system at the heart of everything? Well, it's time to meet the main character of our story. High-frequency trading, or as you'll hear it called, HFT.
At its core, HFT is pretty much exactly what it sounds like. We're not talking about a person on the phone making a gut call here. We're talking about algorithms on super powerful computers firing off millions of orders based on the tiniest little market fluctuations. And it's all happening at speeds our brains can't even begin to process. It's not one trader making one choice, it's a computer making millions of choices before a person can even register a single price change.
So just how fast are we talking? Well, look at this number, 1.5 milliseconds. A blink of an eye takes about 300 milliseconds. So in the time it takes you to blink once, these algorithms could have already executed hundreds of trades. It's just insane. In their world, that tiny fraction of a second is an eternity worth a fortune.
And that number, it has an absolutely wild story behind it. A company spent $300 million to lay a new, straighter fiber optic cable. They didn't just follow the roads. They literally blasted through mountains and went under rivers to connect the markets in Chicago to the data centers in New Jersey. And all that work, all that money, was to shave off just 1.5 milliseconds of data travel time. That shows you the scale of this arms race for speed.
So, this incredible speed, it basically gives these HFT firms a split personality. You could almost think of them as Dr. Jekyll and Mr. Hyde. In the market, they can be the helpful shopkeeper, but they can also be the circling sharp.
So on the one hand, they're liquidity providers. By constantly placing buy and sell orders, they create a really deep, active market. That's a good thing. It makes it easier and cheaper for all of us to trade. But then there's the other side, the liquidity takers. This is where they use their speed advantage to spot and exploit tiny, fleeting price differences before anyone else can even react. They're essentially profiting from everyone else's relative slowness. And you can actually see their provider role right here. This chart shows a stock's order book. All those stacked up buy and sell orders you see, those layers of red and magenta, yeah, that's pretty much all HFT firms. They are the constant background hum of the market, providing the depth that keeps everything flowing.
But that helpful market making definitely has a dark side. Because that speed isn't just for providing liquidity. It's a weapon. And one of the most powerful strategies is something called latency arbitrage. It sounds complex, but here's how it works. Step 1, a stock price changes on a public exchange. Step 2, the HFT firm, with its lightning-fast connection, sees that new price milliseconds before a slower market, like a private exchange called a dark pool, gets the news. Step 3, the algorithm instantly races to that dark pool where the price is now stale or old. And step 4, it buys at the old low price or sells at the old high price, locking in a totally risk-free profit before the other side even knew the market moved.
So you might be asking, just how well does this strategy actually work?
Well, get this. According to the Bank for International Settlements, when an HFT firm is trading against one of these stale prices, they win 99% of the time. Let that sink in. At that point, it's not really trading, is it? It's a guaranteed wealth transfer from slower investors to faster ones, all made possible by a speed advantage measured in millionths of a second.
Okay, so we've seen these tiny, micro-level actions. But now we need to zoom out and see how all these little strategies can create huge, market-wide risks. Researchers have a name for this: liquidity commonality. And it's a really simple but powerful idea. It just means that how easy it is to trade one stock, like Apple, is often linked to how easy it is to trade another, like Google. They're connected. And what's the main thing connecting them? You guessed it, HFT. Because you have the same handful of giant firms running similar algorithms across thousands of different stocks. So if one of those algorithms gets spooked by risk and decides to pull its orders from the market, it doesn't just pull them from one stock. It pulls them from all the stocks at the exact same time. It's a domino effect that happens at the speed of light.
But here is the absolute crucial part, the thing that really matters. This domino effect is at its absolute worst exactly when you don't want it to be. On calm, normal days, that connection is weaker. But on chaotic, high-stress days, days just like the flash crash, the HFT algorithms bind the fates of all stocks together much more tightly, massively increasing the risk of a market-wide crisis.
So where does that leave us? We've got this incredibly complex, light-speed system running the show. What does it all mean for the stability of our markets and, for your 401k? It really all boils down to a fundamental trade-off. On a normal day, HFTs are a good thing. They provide all that liquidity we talked about, which lowers trading costs for everyone. But, and this is a huge but, that liquidity can be an illusion. It can be withdrawn in a microsecond during a crisis. And when that happens, it doesn't just remove a benefit. It actively pours gasoline on the fire. We've built a system that's incredibly efficient 99% of the time, but terrifyingly fragile when things go wrong.
And that leaves us with the one essential question to chew on. In this relentless pursuit of speed, have we really engineered a better, more efficient market for ourselves? Or have we just built a more elegant, high-tech trapdoor just waiting for the right moment to swing open beneath our feet?